Imagine the economy as a clock, ticking through a series of phases: boom, bust, depression, and recovery. This is the economic clock, a tool that helps investors understand where the economy stands and how it impacts different asset classes. Let's see how the economic clock influences the 5 major asset sectors: equities, fixed income, real estate, commodities, and currencies. Each phase of the clock creates different opportunities and risks across these sectors. And knowing how to adjust your portfolio can help you maximize returns and protect your wealth. In the boom phase, the economy is growing, consumer confidence is high, and businesses are thriving. Equities perform well, especially in growth sectors like technology and consumer goods. But when the clock moves into the bust phase, economic growth slows, profits decline, and stocks become more volatile. Defensive sectors like utilities and healthcare are safer bets. During a depression, stocks are typically weak. Investors shift to preserving capital, though some may find bargains in beaten-down stocks. As the economy enters recovery, equities in cyclical sectors like construction, industrials, and consumer discretionary begin to bounce back. The boom phase isn't great for bonds. Interest rates rise to control inflation, and bond prices fall. As we move into the bust, central banks cut rates to stimulate the economy, making bonds, especially government bonds, attractive again. Bonds continue to perform well during a depression as they provide stability. In recovery, short-term bonds are better as interest rates begin to rise again. Real estate flourishes in the boom phase, with rising wages, low unemployment, and easy credit making property attractive. But in the bust, rising interest rates reduce demand for homes and commercial property. During a depression, real estate prices drop sharply, creating buying opportunities for those with cash. In recovery, the market improves as confidence and credit return. Commodities soar in the boom phase due to increased demand for raw materials like oil, metals, and agricultural products. In the bust, demand drops and prices fall. Depressions bring commodity prices to their lowest, offering buying opportunities. As the economy recovers, demand rises again, driving commodity prices upward. Currencies react subtly to economic phases. In a boom, currencies of strong economies rise as interest rates increase. During a bust, interest rates fall and currencies weaken, with investors moving to safer options like the US dollar or Swiss franc. In a depression, volatility increases as central banks intervene to stabilize economies. In recovery, emerging market currencies offer strong growth potential. So how can you use the economic clock to guide your investment strategy? It's all about timing, knowing when to be aggressive, when to be defensive, and when to seek undervalued opportunities. Aligning your portfolio with the phases of the clock helps you adapt to changing conditions and protect your wealth. In upcoming videos, we'll take a closer look at each of these sectors and provide strategies for adjusting your portfolio as the economy evolves. Subscribe now, and let's navigate the financial markets one tick at a time.